Hello everyone! Today I would like to give a small lecture on time series analysis. I will talk about the Kalman filter and its usage in finance. My name is Franz Krekeler and I'm currently doing a quantitative research apprenticeship at Hudson and Thames. My background is computer science and psychology at the University of Hamburg. I'm a full-stack developer with interest in NLP, time series analysis and statistical arbitrage. You can find me on GitHub and LinkedIn. So, let's get back to our lecture. First, we will introduce the Kalman filter, then I will continue and explain the intuition behind the Kalman filter, and then we'll show how the Kalman filter is used as a technical indicator. I will then go further and present a paper, go into pairs trading and how to use the Kalman filter for trading the spread. So let's start with the introduction to Kalman filters. The Kalman filter is a mathematical method for iteratively estimating parameters to describe system states based on error-prone observations. So what does this mean? Imagine you have a rocket and you want to measure the rocket position. The rocket has a sensor, but the sensor is not always accurate. So you try to estimate the correct position and filter out the noise of the sensor. The concept of this filter was invented by Kalman in the 60s. First it was met with skepticism, but then research found a wide range of applications. For example, it was used in one of the Apollo missions. And you have to imagine, back then the computers weren't as fast as our smartphones are today. So this was a very efficient way to correct the measurements in the Apollo missions. Nowadays the Kalman filter is widely used in signal processing. We talked a little bit about precision measurement like GPS, but it can also be applied in self-driving cars and more. So here in this small chart you can see noisy measurements in red, and the blue line represents the filtered or smoothed out measurements. So what is the intuition behind Kalman filters? The Kalman filter is an algorithm and it consists of two basic steps. The first step is prediction and the second step is correction. So here you can see the next position of the car is predicted. Once it's predicted, you measure its actual position. But remember, there might be noise in the measurement. So in the second step, you take your prediction and your measurement and you give an estimate of the current position of the car. With this information, you can predict the next step and repeat the measurement process. A few more notes about the Kalman filter. It is an optimal estimator in case all noise is Gaussian, and it minimizes the error function of the estimated parameters. Let's go back to our visual example. Here we want to estimate the car's actual position. So we start with an initial state. This is our initial estimate where we are currently. In the next step, we want to predict where we should be in the next step, but we also want to measure and then estimate where our actual state is. So combining the prediction and the measurement, we give our optimal estimate. So I now hope you have a small intuition of what the Kalman filter does. Given our predicted state and our measurement, we estimate its current state. So let's get deeper into the steps of the algorithm. At first we're going to talk about the prediction step and then the correction step or updating step. So here we will predict the system state k given our previous state k minus 1. So here we need our transition matrix and the previous predicted system state. Then we add the deterministic disturbance and the dynamics of the deterministic disturbance. In our car example, this could be information about how fast you're accelerating, but this could be also unknown. In the next step, the covariance error of the system is predicted. For this, we need our transition matrix and our previous covariance error. Also, we add the previous process noise. So let's get into the next step, the correction step or the update step. At first, the actual system value is measured with z at time step k and then combined with the observation matrix. This gives us the innovation or I. Then the covariance error of the measurement is calculated. To update the values of the system, we need to calculate the Kalman gain as well at time step k. And then we can update our system value with our previous calculated innovation and our Kalman gain. Lastly, the covariance error at time step k is calculated and repeat our process. Alright, so if you break it down, we have the observed measurements, the supplied parameters by the user, and then the hidden state we are trying to estimate. So in the next step, we will show how we can apply this in finance or economics. Many of you probably already heard of the Kalman filter as a technical indicator. So what does this actually mean? Assuming the returns of an asset are following a Gaussian distribution, the Kalman filter can theoretically be applied to smooth out the data and give a less noisy price estimate. And if you look here at the chart, you can see the actual price at time step k, the prediction in red of the price, and then the optimal estimate in blue. One benefit here is if you compare it to moving averages, there's no need to specify a day lag, and recent observations are more heavily weighted. So we can use the Kalman filter to smooth out the asset prices. If you want to apply it in Python, you can of course try to implement it yourself, but there are also a few packages, for example PyKalman, which will give you a fully implemented Kalman filter. But before you jump right into the Kalman filter, let me state you two problems of the Kalman filter. First of all, as stated, your data might not be following the Gaussian distribution. The second problem is related to smoothing. So imagine every small movement you consider meaningful, and then you won't filter out the noise. But on the flip side, if you smooth out the signal too much, you could lose some information. I found this comic strip from the book Pairs Trading, which describes the situation pretty well. So let's get further into the Kalman filter and its research. I would like to present you a highly cited paper by Shumway and Stoffer, and I will start by reading out the abstract. An approach to smoothing and forecasting for time series with missing observation is proposed. For an underlying state space model, the EEM algorithm is used in conjunction with the conventional Kalman smoothed estimators to derive a simple recursive procedure for estimating the parameters by maximum likelihood. An example is given which involves smoothing and forecasting an economic series using the maximum likelihood estimators for the parameters. So let's break it down. What is the likelihood function and what is the likelihood maximization function? The likelihood function is a function of the parameters of a statistical model. So to give an intuitive example, imagine you are a runner and your results are Gaussian distributed. Given a result, you might want to see how likely this would be. This is the likelihood function. So what is the maximum likelihood estimation? In the previous example, I was talking about a runner and the results being Gaussian distributed. In this case, the parameters of the Gaussian distribution were known. But what if you don't know the parameters? In this case, you're trying to optimize the parameters of distribution by observing your sample data. Some parameters of the Kalman filter might not be clear. So you're trying to use the EM algorithm to find the optimal values for those parameters. So let's give an example of the Shumway Stoffer smoother. Here we have blood data and some missing values. The Shumway Stoffer smoother interpolates the data and provides a covariance interval. To explain how to use the Shumway Stoffer smoother in finance, first let me get into pairs trading. Imagine you want to predict the future price of an asset, but the asset might follow a random walk. Therefore, it's nearly impossible to predict the future price of the asset. So what is the intuition behind trading the spread? Well, you find two correlated assets and you short one asset and you long the other asset. Therefore, you now are only trading on the difference between those two stocks or the spread. Suddenly, those two at first random behaving assets together form a mean reverting process. Here, you can see the spread between these two assets. And you can see that the time series tends to go back to this middle line here. This is meant by mean reverting. If you're further interested in pairs trading, I can definitely recommend you this extensive guide about pairs trading here. Alright, let's talk about how to apply the Kalman filter for spread trading. For this, let me introduce you to a method that was introduced by Elliott and others in 2015. The quick intuition here is that you can use the Kalman filter to smooth out the spread, and given the outputs of the Kalman filter, you can derive trading signals. Here you can see how the trading signal is calculated, and once they hit a certain threshold, or alpha, you long the spread trade. Here you can see example results from a presentation from Richard Knudsen, and you can see various performances. Interestingly, in blue, you can see a synthetic spread. In his presentation, he tried different values for t, which is the time after the trading signal was hit to execute the trade, and alpha, which is a set parameter. There are various ways to generate trading signals, but in this example, The alpha can be also a downside, given you set the wrong parameter. And as stated, there might be limitations as the noise might not be Gaussian distributed. In conclusion, the Kalman filter is a very versatile method for fast signal processing. If you're further interested, have a look at the references and you can also find them in the description. Oh, and I can also recommend you other videos on this channel.